Hit it.
It's July 17, 2020, episode 89. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we interview Nancy Davis, founder of Quadratic Capital, which manages the popular IVOL ETF. We talk about starting out on the Goldman Sachs prop desk, what it's like to be a woman on Wall Street, and how IVOL might be a great way to protect against the coming inflationary environment. Then we have a special guest when SPAC researchers Ben Kwasnick comes back to talk about the hottest investment out there, SPACs. Then Patrick will stare into his mystic crystal ball to see what the market gods have in store for us in this week's Talking Charts.
And then this week in trading history, we discuss the founding of one of the largest banks in the United States. We get Taylor on to share the WTF Clip of the week. And we cap it all off with the top 3 things to watch next week. And Kevin, we might even drink some beers along the way, right? So let's get on with the show and get to our first interview.
Nancy Davis founded Quadratic Capital in 2013 and is the portfolio manager for the Quadratic Interest Rate Volatility and Inflation Hedge ETF, ticker IVOL. Nancy began her career at Goldman Sachs, where she spent nearly 10 years, the last 7 at the proprietary trading group, where she rose to become the head of credit, derivatives, and OTC trading. Prior to starting Quadratic, she served as portfolio manager at Highbridge Capital, where she managed $500 million of capital in a derivatives-only portfolio. She later served as a senior executive role at AllianceBernstein. Welcome to the show, Nancy.
Thanks for having me. Great to be here.
It's great to have you back. And we were just chatting before we got going, and we didn't realize that you have some Canadian roots. Why don't you tell us a little bit about that?
Yeah, my grandparents. I used to go up to Toronto in the summers and do sailing at the RCYC, and so it was a great way to spend the summers. They both passed away since, but yeah, my grandparents lived there. So
you're just like many a Canadian, and you grew up in Florida, and that seems like half of Toronto leaves in the summer or in the winter to go to Toronto, to go to Florida. Why don't you tell us a little bit about your background, how you got into the business, where you went to university, how it all you got to this point where you're managing the IVOL fund?
Yeah, sure. In a nutshell, I probably had a little bit of a non-traditional path. You know, my parents were not in the industry, and growing up in Florida, I really didn't know anything about Goldman Sachs or Wall Street or options or investing. I was mostly outside and dirty, running around doing sports most of the time with no shoes on. And I was very fortunate when I was applying to colleges, I got a scholarship offer for a school up north. So I was very happy to escape Florida, and had the benefit of having a scholarship that allowed me to take classes in any of the universities. And so I was fortunate. I actually took 5 grad classes as an undergrad, and because of my interest in derivatives, I took a lot of classes in the business school and in the about the derivative markets, and I started trading when I was a college student, which was probably a little unusual. I always joke that some women like to buy shoes. In my case, I like to buy options, and it was something I think, you know, and I always advise, like when I teach, you know. Now I volunteer at several universities, and I always tell, you know, my students, and like, you got to do something that you love doing, something that you would literally do for free in your spare time, and try to build a career around it. And that's where you'll have the most success, because it never feels like you're actually working. So I applied to Goldman on the internet in 1997. I'd never, you know, didn't know anybody there. You know, my parents didn't know anybody there. They all thought I was kind of crazy that I wanted to go to New York. And I got, you know, the typical like 20-round interview, blah, blah, blah. And I was probably one of the only non-Ivy League kids at in my training program.
Wow, that's a terrific story. Now, you didn't go to an Ivy school. Where did you go to university?
Oh, so I went to George Washington University, and this is kind of a funny story given what I do now. I had a scholarship there, and at the time, I'm not sure about today, but at the time, the George Washington University was literally the most expensive university in the United States. So I think I've always been a cheap convexity sniffer, even going back to my high school days.
So you, out of university, you got the job at Goldman, and what desk did you start on?
Yes, I was in derivatives, and I was very fortunate because I created a arbitrage strategy out of actually originally out of Scandinavia, and that's how I got pulled onto what was then the risk arb desk. I never did risk arbitrage, but it was basically Goldman's prop desk. So because of this arbitrage strategy, I got pulled into prop, and I was, one of the few women traders at the firm, and it was a great place to be. It was such a meritocracy, and it didn't matter that I was a bubbly blonde from Florida who liked to laugh and smile a lot. It was really just did you make money with the firm's capital or did you not? So it was a great meritocracy. I highly recommend investing for women in particular because you have a lot of control over your career when you're basically betting on yourself.
So you got to tell us, what was the strategy?
So I was doing ADR arbitrage in options format. So we would be, I was trading the Scandinavia book at the time, and I noticed that, say Nokia that traded in Helsinki was trading at 14, 15 vols different than the ADR options listed in the US. And so we built out a model to hedge out the FX correlation and the FX risk. And we had this pretty, large ADR arbitrage book that was happening. When people started to find out that Goldman Prop was behind these trades, we actually used to trade upstairs through $2 brokers because they would get scared when it was Goldman on the other side. But it was a really, kind of a, Goldman really rewarded that opportunistic, like finding opportunity. It was very young. And then when I moved to the prop desk, I was promoted to be the head of credit, derivatives, and OTC trading. I think I was 24, if I remember correctly, 24, 25. I mean, I was very young to be in that senior role, but it was a great firm. I loved my time there. I was there for about a decade, and I was the head of that team for about 5 years.
Well, that's unbelievable that you, as so young, were able to accomplish so much. Now, even within there, you were having some kids, right?
Yeah, I had both my children when I was at Goldman. It's great. Really, definitely, I'm very thankful for having them when I was, younger, because I had them in my, now I'm 43 today, and I have 2 teenagers, and so I'm glad to be moving on from that. I couldn't imagine starting or having toddlers, especially with the pandemic. It's so much easier having teens because they can occupy themselves. But yeah, I'm very grateful for my children. I have a boy and I have a girl as well. They're actually, if you jump to the slide deck that I sent you, there's a photo of them when I rang the bell after we listed Quadratic. Actually, no, I'm sorry, I didn't put that in the slide deck. But yeah, they rang the bell with me when we listed the IVOL ETF on the New York Stock Exchange. It was seeded on a Monday, listed on a Tuesday. Wednesday, we were just kind of making sure everything was fine. And then Thursday, we rang the opening bell. And I actually brought both my kids with me to do that, which was really fun.
That's a terrific story. Not a lot of kids can say that they get to go with their mom to ring the opening bell of the New York Stock Exchange. I noticed as well on your slide deck that you got named one of Barron's 100 most influential women in finance. Why don't you talk about receiving that honor?
Oh, it was tremendous. I was really honored to be on the list. Janet Yellen was on the list, so I felt completely not worthy to be on the list. But it was awesome because there are very few women who are also portfolio managers and on the investing side, unfortunately, and B, founders. So I'm very proud of being a entrepreneur, working for myself. I started Quadratic I founded the firm in 2013. So I've been doing it now, knock on wood, a couple of years. And it's been a wonderful experience. And I think hopefully it will be inspirational to other men and women who are thinking about going off on their own and doing what you guys did, working for yourself and living the dream, right?
Right. So when I was on the desk, there weren't a lot of women, and on the trading desk, but that's changed recently, but probably nowhere near as much as it should have. For those that are women that are listening, or those dads that have daughters that might be interested in the business, what advice would you give them?
Yeah, I definitely think going into a revenue generating role is very important. Like, number one, we need to get more women interested in STEM and into math and into finance. So first, getting in the door. But secondly, when you're in the door, to really take a role that you're tied to revenue, whether it's trading or whether it's something that has a revenue stream versus, operations or compliance, or, I feel like out of the world of women in finance, we need more women on the portfolio management trading side. And it is the ultimate meritocracy. When you have a number next to your name, you have a lot more control than whether you're, a COO or a compliance person where you're more of a cost. So I'd say A, get in the door, and B, try to bring yourself to something where you're actually generating P&L.
Okay, well, that's some great advice. Now, speaking about a number beside your name, let's talk a little bit about the IVOL. You were on a year ago, but a lot has changed since then. Yet one of the things that I noticed when I'm going to slide 12 here of your slide deck, we'll see the performance of IVOL versus TIPS, and you've outperformed since the Corona crisis. Why don't we talk about how this world has changed and what this might mean for your product going forward?
Yeah, I mean, obviously, no one could have predicted that we would have this global pandemic, and it's a tragedy for everyone, and there's been a lot of lives lost. I'm not an epidemiologist. I'm not going to speculate on where we are in the process, but I do think there are certain strategies that have potentially benefited from this type of environment, and I do think the IVOL ETF is one of those, because we finally, after years and years and years, have a catalyst to make this strategy really something that people are talking about. So,
right, I would argue that what the coronavirus has done has woken a lot of investing public up to the idea that monetary policy is not sufficient to restart the economy, and that what we're going to see is really the institution of fiscal responses. And if you think back to the 2008 crisis, we got a little bit of fiscal with the cash for clunkers, but very quickly it was put the other way, and there was all sorts of actual cuts from the Tea Party types. This time what we're seeing is governments that are responding in a fiscal way along with monetary. So all of a sudden we have an environment that seems to be perfectly suited to, at the very least, tips, right? Inflation expectations going higher. What's your outlook for inflation going forward?
Yeah, I do think universally people are looking at the pandemic and thinking it's going to be deflationary. And so I guess being a professional convexity sniffer and somebody who's always looking for attractively priced asymmetry, this is one of those things that I think is just the value hasn't really been tapped yet, because we have had, the U.S. has spent 14% of GDP so far spending, on fiscal spending. It is a huge catalyst, especially if we do yield curve control, similar to what Brainerd was talking about in the fall when we were having the repo markets blow up, was on the front end. I think those are all catalysts for the IVOL ETF potentially, and it's a pretty attractive time because people are looking at. It's really wild actually when you compare the equity, credit, and rates markets, because the Nasdaq, all equities, investment grade credit, everything is trading very well. But the U.S. government bond market is telling a completely different story. And, the 10-year treasury that many people consider risk-free. I know we all agree that that's not the case, but some people consider that the risk-free rate, and it's trading like, it's the end of the world right now. And I think that's largely a result of investors not expecting any type of inflation.
Right, because if you look at, for example, 10-year break-evens, I'm pulling it up here on my screen, and it's roughly 139, meaning that the market is expecting over the next 10 years inflation to be significantly below the Fed's target rate of 2%. And I see as well that in the March lows, they went down to 50 basis points. I don't know about you, but I sure had some sleepless nights with my inflation break-evens at that point.
Oh yeah, no, it's I mean, the thing about break evens is there is no zero bound, right? They can trade negative as they did in the financial crisis. And so it is, I'd say, the more risk on of the treasury securities out there. But I also think owning nominal treasuries, especially where the 10-year or any long duration instrument, it's literally, it's like all risk and no reward at this environment. Like, even if you think, the front end goes negative, and you look and you shock, the 10-year, say 10-year rates go to absolute zero, the most you can make the 10-year yield, it's like less than 61 basis points today. I mean, it's literally, make at most, what is that? Probably 6%, if 10-year yields were zero, which would probably be the front end being negative. But if the market's normalized like they have in equities or credit, you can lose, 15, 20% in price terms pretty quickly. So I do think it's attractive time for investors to be looking to add other things and replace their nominal treasury holdings.
Right. So why don't you, maybe we've jumped ahead a little bit, because although we're familiar with your product from your time on our show last year, why don't you walk through some people that might not have caught that episode about what IVOL is and what it hopes to accomplish?
Yeah, thanks so much. So IVOL is an inflation protected bond strategy. The core holding is a passive bond TIPS ETF, which is just the same. It's a Bloomberg Barclays passive TIPS holding. But then we augment the TIPS that we own with options that are essentially on inflation expectations. Because we do, like, going back to the break-even comment, when you think about, TIPS alone, it's the U.S. government telling you what the inflation basket is as measured by CPI. And, did you know, like, a third of CPI is defined as shelter, and much of the shelter is rent. And so it might not be the best measure for an investor's overall inflation risk. So we augment that Treasury TIPS portfolio, which is about 85% of the fund, with asymmetric. So we have a positive asymmetry, a positive convexity, with options that are essentially on inflation expectations.
Right, and so that's the secret sauce of the IVOL. Why don't we talk a little bit about the different people that are investors, the investor types that might be better off, or at least consider IVOL? Let's just take someone that would traditionally be in government bonds or the aggregate bond index. Why might they find that IVOL is a better product for them?
Yeah, if you wouldn't mind jumping to slide 7 in the presentation, I think it gives a great visual. So some investors have, most people who use ETFs have the bulk of their net worth is in real estate, right? And most professional real estate investors hedge rates. It's just a cost of doing business. But most investors in ETFs don't hedge rates at all. So we have some investors who are using it as a potential hedge for higher interest rates in the long end when mortgage rates increase and potentially when property prices fall. We have other investors who are using it as a hedge, a tail hedge for their equities and credit. And then we have other investors who are using it as a completion portfolio for their passive fixed income. If you jump to slide, I think it's 9, there's just a chart of, thank you. The Barclays Ag is what a lot of investors use as, it's a diversified passive fixed income, where they're not trying to take a bet on, what's going to happen in monetary policy. They're just trying to have a core holding. And I think the one thing that I find really amazing with the investors who are in these passive products is they don't know that, a third of the Barclays Ag is mortgages. And if we learned anything from the global financial crisis, mortgages are short volatility. And that's because the homeowner can prepay whenever they want. So mortgages have, some people call it a convexity correction, but it's essentially a short vol trade. And so IVOL we see as a completion portfolio to give investors, to neutralize the short vol that's inside the mortgages, and also add inflation plus inflation expectations, because the Barclays Ag doesn't have any, it's all, the treasuries inside of it are all nominal treasuries, not inflation protected treasuries. So we have some people that are using it, I'd say, more as a model-based passive completion portfolio.
Right. One of the things that I worry about, Nancy, is that if we do get a situation where the government comes and pegs the yield curve and we do yield curve control, that we'll have a situation where volatility in the bond market will be just sucked down to zero. What are your feelings about that? Is that something that keeps you up at night?
I think it depends what type of yield curve control it is. I actually think what the Fed has been talking about, what Brainerd really laid out in I believe it was November, in response to the repo crisis that we were having even before the pandemic, was front end yield curve control. And I think that's actually could potentially be very bullish for the IVOL ETF, because that would likely pin the front end of the curve and keep the funding markets very close to the zero, policy rate, and try to control and stimulate the economy and make it a transmission mechanism from the financial system, so the central bank as well as the banks, to get to Main Street. And that likely I would expect, steepen the yield curve, because with the front end pinned, the back end can move. And I also think the vol would probably be higher with the options that we own inside IVOL. They would probably be closer to where the 10-year vol is if the front end is pinned. So I think in Australia, actually, the RBA did that earlier this year with yield curve control on the front end. Now, if they did yield curve control a la Japan, that could potentially flatten the curve and be negative and lower vol, to your point. But I think if you think about why Japan was doing yield curve control, they had negative rates in the front end, and they were actually trying to steepen the yield curve, because the yield curve is really the way that you get money from the banking system to the real economy, right? The whole concept of financial markets is borrowing short-term, lending long-term. And when you have a very flat or inverted yield curve, banks don't want to lend money, right? They'd rather just sit on the cash. So I don't think, what are your thoughts on that?
Well, I think it's kind of funny that we've had a situation where the 10-year has gone from 14% in the early 80s to 61 basis points. And now everyone's talking about that the government has to institute yield curve control at this point. To me, until the yield curve actually steepens to the point where it becomes worrisome for the government, I don't see them doing it, except for in the case where you talked about where they might do the front end. And if you go look through the notes, you'll see that most of the talk is actually in the 3-year sector. It's just controlling the first 3 years, I believe. And I think there was recently, last week, some more talk about that in terms of in the minutes. And it was all focused on pinning the front end of the curve. So I agree with you. I still think that the yield curve is going to go to record wides before this is all done, before they would do any sort of yield curve control.
Yeah, I do agree with you. Obviously, none of us have a crystal ball, but in that scenario, that would be great for the IVOL ETF. because we benefit from that scenario. And I do think that's the path that the Fed is on. But to your point, I think, they really do, the yield curve is kind of artificially low. Even in, 2014, the U.S. yield curve was, call it 250 basis points, which was just, it was more normal. And so I think that's the thing that IVOL really gives investors, instead of just being all tied to break evens and tips as measured by the CPI. It gives you access to inflation expectations, because that's largely what the yield curve is, right? Like it's an investor's, like, why would you ever go to a bank and open a CD and lock up your money for a decade only to get paid, 39 basis points more? It's because there are no inflation expectations for the most part in the rates curve.
It's one of the few value trades out there in terms of fixed income.
Yeah, no, for sure. I think, credit, especially investment grade, is very, very tight. And you have to imagine the governments around the world can't save every single corporate. You've already seen defaults tick up. And I think this is one of the few things out there that is really a value play, because you have, 99% of the world thinking, the pandemic is going to be deflationary.
Right. So actually, I'd love to get your insight and your experience and your thoughts about the corona crisis in terms of the market and how it functioned during that point. It was obviously one of the steepest sell-offs that we've ever seen in terms of the stock market, and credit spreads blew out. I always thought that when we had the 2008 financial crisis that we would never see anything in my lifetime again. And I guess I've lived longer than I thought I was going to live, because sure enough, we had it again just a little more than a decade later. What are your feelings about how the markets traded during that period, and are you surprised at the violence of the bounce since then?
Yeah, I mean, that might be helpful to jump to slide 12, where we have kind of some performance of the S&P tips and also the IVOL ETF, because I think, it's definitely a very challenging time, especially for fixed income investors, because you did have obviously a huge sell-off. So it was kind of a wake up to people who have credit and equities that, they both sell off together, right? When equities sell off, credit spreads widen. So I think that was sort of a rude awakening in the first quarter. And we're very pleased that IVOL had such, as expected, great performance in the first quarter. But more importantly, we have also done well in the second quarter when the markets have been recovering. And I think it's really, it's impossible for anyone to know whether we're going to have a U-shaped recovery, a V-shaped recovery, like if we're going to have a recovery at all, right? Nobody really knows. And I think there have never been more uncertainty, and the especially rate volatility, it's incredibly low compared to other asset classes. It's at pre-COVID levels. And so I think it presents a really great asymmetry for investors to have inflation and inflation expectations, and look for something that is a better value in the fixed income markets.
Do you think that fixed income professionals are surprised that the move, which is basically the VIX for fixed income, is on the lows and is so quickly given up the brief gains that we saw?
Yeah, I don't believe it's investable. So I think IVOL is the only product that accesses the fixed income options markets, I believe. I haven't heard of another product. And so I think, the nice thing about having an active strategy is you're able to roll the positions and lock in some of that performance because it's actively managed. I know from when prior to looking at the world of active ETFs, I always thought of ETFs as passive index replication vehicles. And so it's nice to be able to deliver an alpha generating strategy that's able to pivot when vol becomes more expensive to lock in those gains potentially.
And what would be the thing that surprised you most in terms of running an ETF? You're now, how long have you been doing how long has the IVOL been around?
So it listed on May 14th, 2019. So it's a little over a year now.
Okay.
I think the one thing that has been most surprising is many institutional investors are using the IVOL ETF. So we have several professional fund managers. So I didn't create the product for institutional investors, but it has been I'd say widely accepted as an access product because we're accessing the OTC rates market with options, and I think it's been a great surprise to see so many institutional investors using it.
Do you track the retail versus institution, and if so, are you able to share that with us?
So you can see the holdings from in all ETFs from the 13F filings,
Right.
but many of the institutions, like if you they don't have to report their ETF holdings in the U.S. unless they have over 100 million. So a lot of the institutional investors don't show up in those 13Fs until they cross 100 million.
Right. And
it's my understanding. I'm not a compliance person. But
so when you get a institution that comes in and wants to buy a big chunk, are they contacting you so that they can go and create the product, and the market makers on the other side and is saying we're gonna basically do this trade here, we're gonna need you to put 50 million to work, or whatever the number is, 10 million? Or is it just them coming out into the marketplace and buying it and doing it through the ARB in essence?
Yeah, that's a great question. If you jump to slide 15, there's actually a chart that we put together for institutional investors. So most institutional investors are using the primary market to access the IVOL ETF, where if they're buying, they would do a NAV-based create. Those NAV-based create is like the three magic words, where you basically get to execute. It's similar to a mutual fund. ETFs are 40 Act funds, just like mutual funds. And when you invest in a mutual fund, you trade at the NAV. ETFs have the same primary market where you can create or redeem shares at the mark, basically. So that's how institutional investors have been accessing the product. And there's a tremendous amount of liquidity because we use a passive treasury portfolio that's over $10 billion. So we have 17 different APs set up for the IVOL ETF, and any of the APs, they can ask for a NAV-based create and get, very, very large size done at very tight spreads, including my alma mater, Goldman, has been one of the more active APs.
So what does that stand for? AP or AT?
AP, sorry. They're the ones who create or redeem the baskets. So it's not specific to IVOL. It's all ETFs can trade in the primary or the secondary market. I think I have the best analogy would be like, the secondary market is just trading around the outstanding shares of the security, whereas the primary market is creating or redeeming shares in the market. So it's it's changing or increasing or decreasing the shares outstanding.
There it is. Authorized participant is what it stands for. So those are dealers that are basically authorized to contact you directly and make or redeem IVOL units. Is that correct?
Yes, exactly.
Okay. So Nancy, one of the things that I love to do when we're saying goodbye to a guest is ask them if they went back to themselves when they were young, and in your case, just as you said, a young girl in Florida playing sports barefoot, and you had advice for them. You're still young, but maybe you have some advice that you would give the even younger Nancy. What would you have tell her?
I think I was definitely a little bit of a math nerd. I'd say not one of the popular kids. Even definitely in middle school, I went to an all-girls Catholic school, which was torturous for me. But I just say it's all going to be okay, and do what you love, and don't worry about. I think it's now that I'm older, and I'm a little bit of an odd duck, right? Like, who loves trading options and creates the first of its kind ETF like IVOL. But I think it's kind of, I think it's more boring to be like everybody else. So I just say it will be okay. Keep doing what you like, and don't worry about the catty girls.
Well, that's some terrific advice.
All girls Catholic school is like a very damaging experience, at least for me.
Nancy, I have one more question for you, though, when going back to the IVOL. And one of the things that a lot of a lot of my members are always interested in buying your product, but they have a hard time visualizing like what the expected payoff would be if there was a steepening. And I want to kind of ask it open-endedly, because I want you to be able to answer within what you can. But like, what should an investor expect if we were to, let's say, have a steepening? What kind of an impact would that have on your fund?
Yeah, that's typically positive for our fund. The neat thing about this type of IVOL is long only, so it's just a government bond fund with also fully funded options. And so typically you have this unique when the curve is steepening, it can happen from either in the U.S. if we went into negative rate territory. So even if the Fed doesn't cut, if the market, say the equity market sells off a lot and credit spreads widen again, say, in the fall, if we have a resurgence of the virus, the rates market would likely start to price in that the Fed would cut. It usually happens before the central bank actually moves. So we can benefit from lower front end yields or a normalization of the 10-year. And I do think the Fed really wants to steepen the yield curve and have the 10-year, which is considered the risk-free rate in many models, be at more normal levels, because that would encourage more lending, more transmission of money from the banking system to Main Street and the real economy, and also make more of the risk models go more risk on. I really enjoyed Kevin's note about the NASDAQ and how vol was increasing with the equity market, because I was there, in the 2000s. I remember, it was just like vol up, spot up. And this type of option inside IVOL typically has that positive correlation between spot and vol. So as the curve steepens, typically vol goes up as well. So it's got this, I joked with one of my colleagues, I should give credit to him. He's a Canadian former CIO of one of the Canadian pension funds, and he called IVOL Volvexity, which I love. Volvexity. It's like vol with convexity combined. And I was like, I love you, Dave. Shout out to you. It was brilliant. Yeah, it's a really neat feature of this type of optionality where you can have the positive spot vol correlation.
So Nancy, when you obviously referenced Kevin's piece there, where he's talking about these higher vol conditions. What's your take on in the equity markets with the VIX still trading, stone's throw from 30, while we have the markets having now had like a 3-4 month rally? I mean, do you think that we stay in an elevated level of volatility, or is there a chance that we start seeing vol normalization go back to some of the levels where it's been in, a couple of years ago? What's your take on the volatility situation?
I mean, I would say the vol inside of IVOL is crazy cheap. It's not expensive at all. I think especially if you look at relative value between asset classes, like let me read you some of the vol levels inside of the portfolio. It's 2.74, 2.81, 2.6, 2.5. So this stuff is crazy cheap and at pre-COVID levels. So I personally think you can get a better, more convex payoff. Basically the lower vol is, the cheaper the options are. So I think it's a better opportunity personally to look at interest rate vol, like what IVOL does. But on the equity vol side, there's no, we could definitely have markets up, vol up. We could have, a rip, FOMO, people trying to catch up. It could be, we could be in 1999 and we're about to hit the 2000s. So I think it's just a really challenging time for investors. And I think that's one of the reasons that you should be looking for things that are diversifiers. And if we can jump to one more slide, which I think is important for your audience, this stuff is not equities and it's not credit, and it has a really unique correlation. That's on slide 6, which I think just is important to highlight. This is the correlation figures since the fund listed in May to quarter end. And to me, that's like something we don't know what's going to happen, right? We don't know if there's going to be a recovery, if there's going to be rip, are we going to go into a depression? Like, we just have no idea. And I think having stuff in the portfolio that's not correlated to everything else is pretty important for people to be thinking about diversification.
Well, that's terrific. Well, Nancy, you've given us a lot to think about and some great ideas, and we really appreciate you taking the time to explain your IVOL and to tell us about your product. Have a great rest of the summer.
Thank you. You too. Thanks so much for having me back on. It's great to catch up.
Take care. Thanks again.
Thanks a lot, Nancy.
Okay, everyone, hop on.
Hello.
It's beer time. Hello.
It is beer time.
Hey.
So, Lena, what are we drinking?
So today we're drinking Reinhardt Brewing Company's Armed and Citra Dry Hopped Pale Ale. So this dry hopped pale ale is clean and crisp with distinct flavors of melon, grapefruit, and soft pine. Nice. A smooth malt character and body brings balance to this ale, providing a canvas to display the aromatic hops, 4 hop additions, and dry hopped in the fermenter, focusing primarily on the legendary Citra hop. The distinctive citrus flavors are enhanced by the addition of Australian Galaxy hops, lending a soft melon fruitiness to the beer.
You know, with that picture of the tank at the front, I was sure that this was going to explode in my mouth. And actually, it's a really nice beer. I think
I said, pardon? So just moving on quickly.
We're just going to gloss over that.
Yeah. I'm always worried whenever they mention an evergreen that it's going to taste like a pine or a spruce. But actually, I like it. Mm-hmm. I started early, and mine's almost gone, to be honest.
No, this
is
nice.
Is my first beer since last week, and it is it's so fresh, man. I used to listen to this podcast and just hear you guys talk about beers and be like, I want a beer so bad. I'd be on like a bus. Oh, this is the life.
That shouldn't stop you. It's Canada. We're allowed to drink on buses.
All right, Kev, why don't you give us a disclaimer, buddy?
Okay, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include TikTok ticks, OPEC spurts, and unnatural gas.
All right, let's move on.
For our second interview, we are pleased to have Ben Kwasnick come back to the Market Huddle. Ben is the founder of SPAC Research, and he joins us to tell us what he sees in this new hot market. Welcome to the show, Ben.
Thanks for having me back, guys.
Well, listen, it's great to have you back. And I was chatting with you offline before this, and I was mentioning that when we spoke last, you were on the show, and you highlighted the fact that SPACs were trading with a yield to maturity just to tender to the trust that was actually a very positive number, because that was in the midst of the corona crisis. And since then, it's almost like the exact opposite has happened. And one of the things that I contend is that if we look back at the opportunities that existed during the corona crisis, I think that SPACs were actually the best risk reward on the board. Because if nothing else had happened, we could have tendered them to the trust and earned that yield that you had highlighted in our last time. But in the off chance that the market got hot, we would get the equity upside. And sure enough, look what's happened. It's taken off. And not only has SPACs become a positive in terms of the market appreciating the whole structure, I would argue that it's actually become the go-to financing. So
Yeah.
you got. Sorry,
Well,
go ahead.
it's been an incredible run. Back in March, as we saw a liquidity-driven sell-off across all assets across the board, SPACs traded down to, in many cases, 6, 7, 8% yields, even just to the redemption option for cash that each of their structures allows. That's sort of the worst case. You put your shares back to the company for cash if they don't find a deal, or if you don't like the deal. And of course,
right. Actually, Ben, before I don't mean to interrupt, but why don't you, for those who didn't listen to your last one, why don't you just very briefly run through what a SPAC is, how it works? Just very brief, like the Coles Notes version.
Sure. So a SPAC is basically a vehicle in which a management team will raise a couple $100 million in an IPO and put the proceeds into a secure trust account, only to be accessed to fund a business combination or to redeem shares back to shareholders who choose not to continue on for shares in the new company. So the management team hopefully has expertise in operationally or financing or M&A. We'll go out and try and find a great company to take public through the SPAC listing route, and then submit for approval to shareholders. And assuming they get it, go ahead and close the deal and take the company public sort of through a side door. And for compensation for tying up your capital for 2 years, you get this share that's linked to the trust account where you can ask for your cash back if you don't want to stick around for the new company. And then you also usually get a warrant or a fraction of a warrant, basically a 5-year out of the money call option on this future company to be named later.
Right. And so this has become an increasingly popular way to raise money. And why don't you walk us through your first slide here where you show the IPO activity in the SPACs over the last, 5 years?
Yeah, so it's become increasingly popular. We've seen a handful of really exciting companies that are household names use the SPAC listing route lately. And as more and more high quality companies consider this way of going public, it also draws in more investors on the front end, and it draws in high quality sponsors to go out and raise the vehicles themselves. And so in many ways, it's been a self-fulfilling loop where good results breed higher interest in participation across all sides of the ecosystem, and has led to a first half of 2020 that saw the highest issuance ever, almost $12 billion in the first half. We're almost crossed the line of, I think, 13.6 is what we raised in all of 2019. We might be over that line already with the July IPOs, and clearly it's just been hugely popular.
Right. And so you brought up about a graph here that shows the yield to maturity of the SPACs, and you've got it over 2 different timelines. And this is one of the things that I want to make sure people understand is that this environment that we're in currently for SPACs is much different than when we spoke last. So why don't you walk us through the different timelines and how SPAC pricing has changed since you were last on the show?
So we talked about the depth of the sell-off in March when SPAC common shares were trading at a 6 or 7 or 8%, or in some cases double-digit yield to maturity. And basically what that means is there's 2 pieces to the SPAC IPO. There's the common share that's linked to the cash and trust. And then there's the warrant, which is the out-of-the-money option on the future company. That'll be worth 0 if the SPAC can't close a deal. But just to be clear here, we're just talking about the common share where you can redeem for cash if you don't like the deal. You can think of that SPAC common equity as sort of having 2 components. One is it's a 0 coupon bond where you're going to get the amount of cash in trust at the liquidation deadline. And then sort of layered on top of that, there's the conversion option, the part where you get to the option to own the company that the sponsor finds during the period between when they announce the deal and when they actually close the deal. So under normal circumstances, SPACs have traded at a discount to cash in trust because there's a bit of a liquidity discount, and ultimately the primary driving factor in SPAC common equity value was that 0 coupon bond. But for great sponsors, people have been interested in speculating on the value of the company that they were going to eventually find and take public through their SPAC. In March, we saw 6, 8, 10% yields. This chart is from just 6 weeks ago, and is sort of a more normal circumstance, at least historically, where most of the group is trading at a 2, 3, 4% yield to maturity, depending on who the sponsor is and how much time it has left. And I brought this chart along with the next one on slide 3, just to demonstrate how much things have moved in the last 6 weeks. You can see most of the SPACs that are out there have flipped to a negative yield. What that means is people are paying a higher price than the amount of cash that's expected to be in the trust account at the liquidation deadline to own it. So if there's $10 in trust and there's a year left and you're paying 10 spot 50, that's a negative 5% yield. And you're basically speculating on the fact that the sponsor is going to find a great company to take public if you want to realize a profitable return on your investment. There's another sort of interesting layer here, which is that historically SPAC trust accounts have been funded by SPAC ARB funds, basically funds executing a carry ARB trade where they're trying to beat their cost of capital by allocating to a positive yielding instrument, and in many cases doing it with leverage. You sort of need a positive yield if you're going to do that, which is why it's fascinating to see the activity over the last couple months or so. As the broader market has rebounded, people have been willing to really speculate on the business combinations that are going to come out of these things, even in the absence of a positive yield. Just another sort of corollary here is, as people watch the broader market and its seeming disconnect with economic fundamentals, you can see why people are interested in a product that's got a redemption put that provides some principal protection, but that still has equity upside.
Right. And there's been a lot of, let's just say, exciting SPACs recently, and I know that you're kind of restricted in terms of talking about individual names, but I'm not, so I'll talk about them. Originally, it was Virgin Galactic was one of the big names that took off, but since then we've had Nikola, we've had SPAQ, which is actually putting the Fisker electric car in there. There's been all sorts of really hot SPACs that have gone from $10 to $50 in just in a short order, and that's what's really driven everyone's attention to it. And I see that even guys like Davey Day Trader, Dave Portnoy is all over these things. So this is part of the reason that these stocks are now trading with an embedded a premium in them. And I guess back to your first chart where you said that there's more and more IPOs out there. If you have a situation where people are willing to pay a premium, then that means that we're going to get a lot more new issues, wouldn't you say?
Yeah, I mean, it's certainly true that any asset class that develops momentum has the potential to drive more and more speculation. But it's been a really successful vehicle for front-end IPO investors historically. So it makes sense that if you continue to see high-quality results coming out the back end, that the demand will remain strong. So I think the increase in IPO proceeds this year, it's a blend of demand on the front end and issuers, high quality issuers, stepping up to meet that demand by putting capital into trust accounts and going out to try and recreate the magic on their own.
Right. And so just for people at home that are thinking about these things, it's one way to think about it is that before you could buy them around the issue price, or maybe it's like discount to the issue price, and then you had almost a call option on whether the management found a good deal. And if the good deal happened, then you might sell it at $15 or $20 if you're really lucky. And then if it doesn't happen, you could basically put it back to the SPAC trust and just earn your carry, let's just call it that. Now, what's happened is the whole universe has been bid above the $10 price, and often they're trading at what you highlighted there, which is negative yields, meaning that these companies, if they don't find a good deal, then and what happens is the trust, you have to put it back, you will now actually be at a loss. Is that correct?
It is correct. The first thing to remember, and this is really important if you're coming across the product for the first time, is that you really do have to pay attention to what's going on, because if you just forget about your investment, you're liable to end up with shares in a company that you didn't intend to own. You do have to actively elect to redeem for cash. So that's part number one. Part number two is you're absolutely right. Buyers of many SPAC common shares above cash and trust are taking principal risk on their investment. Really, we haven't seen that happen in the past. So if there is $10 even in trust and you're buying it for 10 spot 50, even if you do elect for redemption, you may lose down to that amount from your initial investment.
Right, and speaking about that election and staying on top of it, therein lies the real art to SPAC investing, and what it's not as easy as it sounds. In that there are all sorts of deadlines, all sorts of complicated times that you need to elect for things. I know I personally missed one, and the next thing you know, it's trading below your what in essence is a put, and you've lost money. So why don't you talk a little bit about what your website does and how that might help the investor that is investing in SPACs?
Yeah, sure. So SPAC Research is a comprehensive data product focused on U.S. listed SPACs. We cover all U.S. SPACs from initial S1 all the way through closing of a business combination. We've got the entire data set from the unique terms of unit and warrant structures, the sponsor promote, what kind of share ownership do they have, how did they structure their risk purchase, that is their contribution to the vehicle, who are the principals, do they have sponsor SPAC history, have they done a SPAC before, and then we also have a synopsis of every single press release and SEC filing throughout every SPAC's life cycle. So if you've ever spent time digging through the Edgar database trying to identify what does the communication from a company mean, and it's the legalese in an 8K, we try and make it much easier to follow along with the entire universe. And then we've also got a bunch of tools built on top to sort and filter the set of available SPACs. So
if you're going to go and look into this asset class and you want to do it yourself, this is a must-have, and I highly recommend people to go and check out Ben's website. Now, let's go on to your next slide here. You have, in essence, almost the discount to trust, and we have the same time frame, that June 4th versus the July 15th. And I guess what this is showing is the premium to to the NAV that we were talking about between those two periods. So it's almost the inverse of the yield. Is that correct?
Yeah, I mean, you're basically looking at the same thing. If you go back to the June 4th trading discount to trust slide, basically this is just a different visualization of the same thing. You know, maybe fixed income folks are used to looking at yields, price down, yield up, et cetera. This is really just sort of a discount to NAV situation, as you said. And this is just 6 weeks ago. You can see that there's a cluster. Most of the SPACs were trading at a discount to NAV, really along a trend line. Again, on the June 4th, it's trading at a fairly straightforward. I mean, this is a visualization of the yield. If it's got a year left, it was trading at 98%, yielding approximately 2%. And there were a handful of names where investors had been willing to speculate above cash and trust to bet on the sponsor. And then if you skip to this week's chart, July 15th, you can see it's just incredible that how many names are now trading above cash and trust. And obviously, the market has been interested in speculating on these names to see what they're going to bring rather than just trading them as a yield product. So it's gone from something that's traded like a bond to something that's trading like an equity in many ways.
That's a great way of putting it. One of the things that I guess is confusing to some people is what makes different sponsors and different SPACs trade above the NAV. Like, what are the kind of the fundamental characteristics of the ones that there's more hype that occurring in?
So the job of the sponsor is not just to go out and find a great company to take public. It's also to structure a deal that's going to be favorable to all parties and certainly to be attractive enough to the buy side to incentivize investors. And then they have to go out and sell that deal. So the sponsors who are affiliated with large financial institutions that can write a check out of a fund to support a transaction, or those that have operational expertise within a specific industry or both of those things together, those tend to attract a premium valuation. And then also sponsors that have done it before, that have demonstrated the history sourcing and financing a deal in the SPAC format, tend to trade at a premium because the market can say, we've seen you do it before. We think there'll be a greater likelihood that you can do it again.
Right. Now, so far, we've talked mostly about the actual common shares that you can put back to the company. But most of the time, as you mentioned, when a SPAC comes out, it consists of both a common share and a warrant. You've made the SPAC Research Warrant Index. Why don't you walk us through what this is and what it's showing?
Sure. So we wanted a way to measure how expensive or cheap SPAC warrants were in the aggregate. So we put together this index on our site. It measures the ratio of the market cap of all SPAC warrants out there without an announced transaction to the initial trust account value for those SPACs. So basically, you're seeing how much is the market willing to pay for SPAC warrants that haven't announced a transaction. And in March and then really in April and May, trailing the broader market sell-off, you saw those warrants get extremely cheap. There wasn't a lot of speculative demand in that moment for SPAC warrants. But then as the market rallied, as a handful of pending and closed business combinations traded extremely well, and more high-profile transactions were announced, you started to see more and more SPAC warrants trade up, reflecting demand for the next deal and what it might be.
So, Ben, speaking about SPAC warrants, I know that they're often very unique and have, let's just say, unique features that make it difficult for regular investors that aren't familiar with them to start again. That's a bad question. Let me just do this. I liked my gotcha, but I kind of get the feeling you didn't like it as much as I did. Okay, let's do it again. Okay. Ben, speaking about SPAC warrants, one of the things that that trips up a lot of people or a lot of investors is the fact that they're very unique and they have different qualities that are not standard. And one of the things that I think would be helpful for investors is to understand how they differ and what they should be on the lookout for. Yeah,
sure. So it's definitely important to understand the specific terms of each SPAC warrant. They are all unique. And they do all have different features, and they can be challenging to value sometimes. The first thing is they're issued by the company. They're not a listed option, and they don't always realize the Black-Scholes trading value that you might expect. You have to guess at using an implied vol number for a stock with no trading history, so that's an impediment. But the other thing is, if you are going to try and exercise your warrant, you have to wait for the shares underlying the warrants to be registered by the company, which we've seen a couple times recently in high-profile instances where warrants have traded at less than what you'd expect their intrinsic value to be, in large part because they weren't yet exercisable so soon after a SPAC business combination has closed. Then there's another piece, which is that they may not necessarily be arbable because there can be an expensive borrow cost associated with trying to collapse the difference between price in the common and the warrants. So in summary, it's worth understanding the unique terms of each individual warrant and making sure that you understand what you're looking at.
And I would contend that a lot of investors are going out and they're seeing the stock take off, the common, and they're saying to themselves, oh, look at this warrant. It's so cheap. I'm going to buy it. And they don't understand all these different nuances, and they're getting themselves into trouble. I know that I've been busy doing the ARB on these things and trying to understand how to take advantage of it. But it is a complicated affair. It's not just a pricing issue. It also ends up being a politics issue because you've been a little more kind about it, but a lot of times the SPAC sponsor has the ability to do what's called a cashless exercise, and they can play games with how they go about exercising it. So I would give everyone a big, huge, be careful with the SPAC warrants. They are, for the most part, like great when you buy a new deal. But as they go deep into the money, some funny things happen in terms of pricing.
Yeah, I mean, I would also say, if you're a SPAC warrant owner from IPO, it's fairly reasonable for the company's perspective to say, if we delivered you an outcome where our common's at $18, which is usually the threshold where they can force you to exercise, that they've delivered a really successful outcome. So to the IPO buyers, that does look like a pretty great outcome. To anyone buying in the open market, I would just say it's absolutely worth understanding all of the unique and specific terms of the individual security.
Right. So one of the things that I've been trying to grapple with is if you're a hedge fund that is investing in these SPACs, and generally you've gone and you've owned these things because you know you have a put. As they've moved higher and they've moved above that put level, and some cases significantly above the put level, it's going to be tougher and tougher for them to own it, because what they've marketed it as, let's just say, a low volatility fund, all of a sudden becomes more volatile as it becomes behaving more like equity instead of bonds. Would you agree?
Yeah, I would absolutely agree. As SPACs trade above the cash and trust value, the owner of the security is taking more principal risk than they did before, because the redemption put only covers you to cash and trust. So it becomes harder to own on leverage. And it's also worth considering, again, historically, most of the SPAC trust accounts have been funded at IPO by a group of funds executing a carry arb trade. And so they may not even have it within their mandate to hold past business combination and to take significant amounts of principal risk. So it's probably been a really interesting period for these guys over the last few months. And I'm really looking forward to seeing what their 13Fs come out with for the quarter ended June 30th, to see how they've adjusted their portfolios over the course of the rally.
Right. Speaking of interesting periods, I think some things have happened and changed in your life as well. You've all of a sudden now have a second website. Why don't you tell us about that?
Yeah, so we launched a new public-facing website called SPAC Alpha in June. It's focused on covering SPACs from a fundamental perspective during the period from transaction announcement before closing. For sponsors, they come out with a transaction, and for a lot of SPACs history, it's been really hard to get the attention that they want to try and tell their story. So we wanted to use our reputation as an objective analytical source of data and cover these transactions. We're not putting a price target on here, but we're trying to give people a sense of what the company and its business model are, and give a valuation sensitivity analysis before the period where the sell side won't cover these deals until the transaction's actually going to close. So we wanted to fill that gap and cover these deals.
Okay, so Ben, in wrapping up here, we have to talk a little bit about the fact that you are an American. You're calling us from America, but you're actually north of us. We're sitting in Toronto, and you are actually in a more northern part of the world. Where are you, and what are you up to?
I'm in Frankfort, Michigan, technically north of Toronto, here in the cherry capital region of the Lower Peninsula of Michigan, and trying to figure out what to do with my kids before they go back to virtual school here in the fall. So
what is Michigan doing for the kids? What is the plan currently?
The northern region probably has a different outlook than the southern region. We've not heard anything definitive yet, though.
Okay, I know for us, like in Ontario, we have opened the rest of Ontario, but on the southern Ontario, like the Toronto area, is still closed. So we're not closed. We're at a different stage of the lockdown, or whatever you want to describe it as. But so you're on a lake. You're enjoying the fine weather, getting out. You were telling me that you no longer have a commute into work, so you're have a little more time on your hands.
I don't know if I'd say I have a little more time on my hands, although I do miss the commute from my daily routine a little bit.
So you don't have more time on your hands because you actually have some kids to take care of?
I've got 3 kids who are all single digits, and SPACs have been busy. Right now we've got something like 120 active SPACs in the market. And there's actually another $8 billion worth in the pipeline, which is like a third of the amount out there. So there's just been a lot of news, a lot to cover, and working hard to keep on top of it all.
Did you ever think that we would be here? Like when we spoke last, did you ever imagine that it would get as hot as it did?
I try not to make too broad or sweeping overall predictions about anything. So I'm not going to say I anticipated any of this.
Yeah. Because I've been shocked that at how it has gone from being something that was almost tossed away at dumb prices to now something that I think that they're reaching for in a kind of almost scary way. And I understand your argument that there's still a put there, but the put is a lot less, and you really are taking a lot more equity risk, which is a completely different game than it was when we spoke last.
I respect your opinion.
Spoken from as a true SPAC bull, I understand that. And listen, I understand the argument as well that if you think about it, if all equity risk has got unlimited downside, or at least limited in terms of it can go to zero, whereas a SPAC it'll go to the trust value, and you're always stopped out there. So in some ways, it's still a much more a trade with more protection on it than most other equity trades.
Yeah, I mean, a product with principal protection and equity upside is always going to be inherently appealing. So I think SPACs continue to deliver that opportunity for a lot of investors. And, we don't know where the broader market is going, of course, but hopefully we see more and more high quality business combinations coming from great sponsors in the product.
Well, it's great chatting with you, Ben. Thanks for taking the time, and we look forward to chatting again when they're even higher.
It's been great, guys. I really appreciate you having me on again.
All right,
okay,
take
care. Okay, Patrick, my favorite time, talking charts. What do you got?
Okay, so let's start off, first of all, just having a quick look at the S&P, just to start and give context for everything, because really, since last week, there really hasn't been too much that's happened. I mean, the market crawled a little bit higher, and we more or less stopped around the 3,200 level on the S&P into this option expiration period. But what was interesting is when we look at the secondary markets, the NASDAQ had that big reversal at the start of the week, and it has not attempted to rally back to that previous high. And one interesting thing was that almost epic call you made on Tesla. So I wanted to do a shout out for you because you rarely get things right, and this one you somehow nailed magically. But there was almost it was like, what is that, 15% update? You were calling for like a 20% update, and then it was going to end on down on the day. And right. It just happened textbook like you've seen this before or something. And
almost like I know what I'm doing.
Almost. It doesn't happen often, but yeah. But the thing is that's interesting about this is that and it's a really important thing to ask. Are we going to have that this is just a pause before a continuation of another major leg? Or do we have a deja vu of February where it kind of just goes back and retests the highs? Or is this just going to almost like V-top and it's going to head lower? And really, it's about its earnings, right? We'll talk about that in top three, but there's clearly a catalyst that is going to be introduced for this, right?
I don't know, Patrick. To me, this looks like that was the top.
It does. I know no, there's no denying. Whenever you have a big red candle like that, yeah. At least often these things can be retested on the high, but it does feel like a top. That does. So
at the same day that happened, a lot of people were saying similar things about the tech stocks and the NASDAQ in general when you pull that chart up. And I remember telling people that my letter, I said, it's never that easy. A lot of times what happens is in terms of the whole index, they rally them back up and they try it out again. I feel on the individual stock that you can say for sure that was the top. It was the epic kind of blow off. But on the stock market, it almost seems like the index, they always push back one more time. And I've been shocked at how badly NASDAQ's traded. I don't know.
Yeah.
This is your
Yeah.
segment, but I would love to kind of highlight the fact that go look at the NASDAQ versus the IWM, like the small caps.
Yeah.
That's the story of the week, right?
Right. Like, well, I'm just going to put on like put on a 1 hour chart and compare that to the Russell. And you have to look at just, you know what? I don't know what you're like. I mean, certainly the Russell's been making higher highs in the orange. So it's more like the NASDAQ's been mean reverting. But
this whole week, the trouble is you're going back a month there. If you go look this whole
there you
week,
go. This is what you're looking at.
Exactly. That's what I want you to show. For the whole week, we sold off. The Russell sold off less, and since then, Russell's been bid, tech's been for sale. That's the story. That's the theme. Basically, what's happening is people are moving out of the tech stocks into the real economy stocks, almost like they know that there's going to be a reopening that catches hold, and that the trade of buying the Amazons and the Netflixes and all those are over, and they're rotating into the broad market.
That's actually the big question to solve, right? Because, I mean, Cuppy had that one tweet out that was showing the S&P 500 broken down by market cap and the performance of each one of those different tiers. And almost all the performance was in the mega caps, and the smaller the market cap in the S&P, the worse the performance. And so, like, when you look at here, and this is the momentum to value breakdown. Obviously, we had that huge slam in momentum over value back in May, and then it just ripped higher all over again. And it's topped again, at least on the short term. Obviously, I don't want to suggest that this has to be a new trend, but it certainly has hit some sort of a short-term high. And I would imagine that in your narrative that this is going to potentially be a reversal. Would you say that?
Well, for sure. And I think there'll be new momentum stocks. And I'm not necessarily saying that you have to go out and buy the value, but I do think that the big cap tech leaders are going to pause, and they're going to have some trouble. And the real question is, can you have a rotation without a correction?
We've seen it before, but I think that it won't happen. But anyway,
like, of course, you're always bearish.
But like it can happen. That's not my favorite narrative. But it's happened before. There's no denying that is definitely something we have to keep our eyes out for to see if it plays out. So I want to move on to uranium. And uranium more or less has spent, this is the uranium participation unit. We're just going to look at, this is the one on Toronto, but obviously it also trades in the U.S., and what we saw was a correction to the downside, and the whole thing's rolling up. And it looks like it's ready to go on the upside all over again. But what was particularly interesting is when you look at the uranium companies and the breakout, and that's what I was really interested in. Notice this is the global uranium ETF. Broke into a higher high. And I mean, it basically is now broken out of this all the sequence of highs over here. So it's a very key breakout. And with one of the big boys, Cameco, has just blasted off on the upside. And even a nice breakout candle coming in here on uranium energy. You can see here that this is breaking out of this like descending flagging formation or wedging formation on the upside. And so one of my big things I want to bring up to everyone is the uranium going for a big run here.
What's interesting, Patrick, is this is happening at a time when the Trump administration refused to create a special kind of reserve for uranium. There was lots of speculation that they would go and they would buy 1% of the world's uranium and stick it in reserve. And that just recently got kiboshed. Yet we're still getting the rally. So obviously those things don't matter. Yeah. And it's an up
this is
tape.
definitely a thing to watch. It looks like it's a full-on breakout right across the board. And using technical measured moves, there's still plenty to go on these if this is the beginning. And so this is definitely something to watch. The other space that I thought was really interesting, the way it was breaking out, was the biotechs. So here's your IBB, and you can see the biotechs making higher highs. Clearly brushing off almost all little short-term corrections and just pumping along. Another one of the big ones within the IBB was the Amgen, which had that big drop and this beautiful bullish engulfing candle coming back the other way. And what's always fascinating about a drop that gaps lower like that, and then it's bought immediately and then closes actually positive on the day. That's almost the opposite of your little Tesla narrative, which is, it gaps lower, spooking out all the weak hands, and then immediately the big boys come in there and just buy up everything that's not nailed down. And I'm curious whether or not this is going to drive that next impulse on Amgen to like 280 to the upside. It looks bullish to me.
Patrick, only you would call something a beautiful engulfing candle. What does that mean? Why don't you explain to us?
Well, it's where this green candle engulfed the prior small little tiny shadowed candle. And there's a little bit of a wick standing above, but it gaps lower decisively from its closing price and then rallies all the way up, engulfing its prior candle.
Nice.
Right, and so that's a sign that something spooked the market, and then the buyers just bought the dip and just ripped it the other way, and that's a sign that it's being being well accumulated, and the buyers are still very interested in keeping the price elevated, and that's a good sign for continuation. I think that this chart can keep going, and what's interesting is when you look at the broader healthcare. This is the XLV, which is all the pharmaceuticals and everything else. They're also breaking out. And so, going back to that point you were making about rotation, clearly some of that's going into the healthcare and biotech spaces, right? And another interesting chart that I thought is asking the question as to whether this breakout in copper is for reals. Listen, I'm a very big bull on copper over the long term, so this is I'm not trying to talk shit on this, but it's gotten a little ahead of itself. I personally think, now that we have approached all these previous highs, I just think there's room for it to backfill here. I think
Patrick, it's going higher because I completely agree with you. It's a prairie dog.
I don't know if it's a prairie dog. I mean, it's hitting this previous high, so I don't know if that's.
No, but
it's prairie dogging the December high yet.
Yeah.
But I don't. But I don't. You don't think we're going back to 2 though, do you?
No. Listen.
No. We're talking about
way back when. Remember when I was bullish? I was bullish way lower. And now it seems like everyone and their dog is bullish.
But this is you, the ARB guy, and you're basically just it's gone a little too far, and you just accept that it's going to mean revert a bit. You know what? Could we see 275 again on copper? Yeah. Should that probably be a buy on dip? I think it will be a lot like the buy on dip on uranium, which is that after it had its blast higher, it spent a month or two just kind of backfilling.
Right. And then I think I think the time is more important than price there.
Yes.
I think that we're going to have a month of backfilling. You should probably look at it in September.
I think it could go as low as 275, maybe 260 if it's really steep, but I don't think it has to go that low. And then if everything stabilizes very well, then you buy it. You buy that dip. Lumber, wow, what the hell is going on?
I'm such
a
knob because I was so bullish on all this crap, and I'm not long enough. So this is kind of like a pointing salt into my wounds, like having this thing just rip higher like this.
All right, well, let me get the salt shaker out then. No, but but this clearly, like even after that kind of a blow off on the upside, and it reverts back to 500 and immediately bought again. There's always a risk that it double tops. After such a parabolic thing, it kind of rejects as it approaches its previous high. But if this thing can go, if you look at that last run in lumber, this thing just kept going and going and going, and it did not quit until it was like 650, right? And we're down at 550. That major high is still 100 points higher. If this does not stall by Monday or Tuesday along its previous high, then it's going all the way to 650 again. And then you'll be like the salt will be shaking on your wound even that much more.
Yeah. I'll be screaming in agony.
So what I wanted to talk about is some of these grains. Look at the way wheat broke out here. And what's interesting is corn's been dogging it. Soybean has turned up, but corn had this kind of big drop the other week. And it hasn't recovered as much, but it'll be really interesting to see whether this grain space altogether has established its bottom and generally starts to gravitate higher. I mean, it's been just such a shit place to be for the last half a year. And
half a year, Patrick. It's been the shit place for 5 years. It's even longer than that. It's
let's
Patrick,
put it on
I'm
the monthly
actually
chart.
Yeah, it's
like
God,
yeah.
I wish I
yeah.
had never seen it because I can't tell you the amount of money I've lost trading these things. I'm a sucker for this. Like I see these, they're cheap.
You're a Winnipegger. That's the problem, right?
That's right. I'm a prairie guy in my blood. And the thing about farmers is they're gamblers. They're crazy gamblers. They don't like hedging. They made these markets, and none of the farmers sell them. They're always like, "Oh, we'll let it ride." They do their best, Richard Dreyfuss. Anyways, I can't stand these things. You know what? They're probably headed higher because I'm not involved.
Yeah, that's probably it. So listen, I wanted to talk a little bit about corporate bonds. And what's interesting is, okay, so let's just start with what the most obvious thing is, like the junk bonds, whether you look at HYG or the JNK. Obviously, the Fed is dipping their beak into some of this stuff.
Very minorly.
Minor. It's just dipping a little bit just to provide some liquidity. But overall, it's been slowly, you could see the correlation to equity. It looks like very much like a Dow Jones or a Russell chart, right? Like it just seems like it kind of off of the worst levels, just trying to turn up here on the upside. But what is interesting is the investment grade corporates using LQD. And now this has been playing a huge catch up. So what we had was that scenario where Treasury bonds like the IEF and the TLT, like whatever, you pick your poison, your 10-year or 30-year duration, they had a huge rip during the crisis. And at the same time, the corporates went completely the opposite way, right? Because if you're in a recession, credit spreads blow out. And what's been amazing is that Treasury bonds have basically flatlined, and these investment grades have been crawling higher as this overall OAS spread between Treasury and these investment grades have slowly, that gap's been narrowing. The question is, do you think it keeps going and the spread goes right back to like 150 basis points for this is the triple Bs? Like, what's your take on this?
It very well could, Patrick. There's a huge bid. And the Fed hasn't even spent that much money. They're in there buying, but the reality is that they haven't had to buy that much in to get that sort of market action. What's interesting as well is that this was in the face of record issuance, like crazy record issuance, meaning that these companies are selling tons and tons and tons.
While they still are creditworthy, because when everyone sees their freaking earnings in a couple of months.
Patrick, you've been bearish for so long, but like it just keeps going that way. And what if it never comes in? I don't want to say that it's going to go to all-time lows because maybe in terms of the credit spreads, but I don't want to be betting against that because the moment that there is any sort of backup in yields, the Fed is there with their bazooka.
I'm on
it's not even a bazooka.
I think that's nonsense what you're saying. I think credit spreads will blow out all over again.
Imagine you're trading against somebody that has no margin calls and can write as many tickets as they want.
Okay, we're not going back to 2008 levels of that. But this idea that these credit spreads because of the Fed will stay narrow like this forever, bullshit. We're going to have liquidity events. The Fed is going to always be, especially in the bond markets, will be there, but that doesn't make it a risk-free trade. And
it's not a risk-free trade.
But you're making it sound like that.
No, I'm just saying it's a bad short, which is different than it's a risk-free trade. Because I agree, there's very little upside, but there's very little downside. It's a shitty trade. Anyways, that's what makes a market, man. That's what makes a market.
So
I'll sell you your puts that you overpay for.
All right. So all right. So I wanted to just touch on the Canadian market. We don't talk too much about it, but the S&P TSX 60 broke to a little higher high. And what's interesting...
sorry, I didn't mean to interrupt. Go ahead,
No,
Patrick.
go for it. I was just going to...
Well, I was going to say the boys on the desk were talking about the 200-day moving average has finally got above it. Is that correct?
Oh, depends on which one. Let me see. I think I have the exponential here. Hold on.
because they were highlighting this, and because we've been sucking wind in Canada. Our stock market stinks because we.
This
don't
is
have
the simple moving average. Yes, there you go.
Yeah, see, there you go. We're for the first time we poked our heads above.
And
the 200
what's
day.
interesting is that even like Canadian banks. So let's just look at Royal Bank for whatever reason. It feels like the Russell chart, right? Like it just like caught the bit.
It does look like, I don't know much about technical analysis, but I'm pretty sure that's a cup and a handle.
Yes. That's a consolidation, and so like, do you bet that there's some big recovery in Canadian banks? Like, there's a lot of you can go right across the TSX 60. It's not just Canadian banks, and a lot of these Canadian stocks all look like this Royal Bank chart, which is they had this consolidation throughout the month of June, and they're all attempting to break out. And I think it's a big puzzle piece to solve is the breakout for reals.
Well,
and
for reals. You sound like a 16-year-old girl.
For reals.
Yeah. So I would argue, though, Patrick, that it's probably going to go with the IWM. Same trade. It's a real economy trade. So if you believe the real economy is taking off the global, and I would argue it's probably the global economy that it's reflecting, then you should buy it. I don't think, though, that there's any rush to buy Canadian banks. Canadian banks, like, they're just...
Yeah.
They're overpriced. They're disaster. I'd rather own American banks any day of the week than Canadian banks.
So I'm going to bait you to try to get you to Gucci your Euro trade. You have any opinion?
Nope.
Okay, good. I was just checking.
No.
All right, so
I'm not as foolish as Cuppy. Nobody asked Cuppy, because if Cuppy just says that
you know what? I'm going to get it's so close that I got to get Cuppy on quickly. Like, let's call him up right now quickly. Like, Lena, can you get him on the line? Let's get him on. Let's see if we can get him to Gucci the trade. All right.
Okay.
And the bet. Anyway, so what's interesting, I wanted to just finally leave with some precious metals. And, I was really commenting on how there doesn't seem to be any tailwind behind a breakout on gold. Like, usually when you have this a breakout to new highs, it usually gains a little bit of momentum. And it's not. And what's interesting is there was a sell day yesterday, but the buyers bought it to add maximum confusion. Like, you would think that yesterday's sell candle would have broken the market if it was going to begin some sell cycle, and then they came back right in there today and just bought it. And
I agree. Sorry, Patrick. I was going to say there's a trend line there that every hedge fund was watching. I joked and said every hedge fund with a ruler.
Yeah.
And I Gucci'd it by highlighting it because it didn't seem to crack, and I was surprised at today's strength. So you look at it and say there's no momentum to the upside. I look at it and say this had every reason to sell off, and I'm surprised
it didn't. No. I'm actually saying that, because my opinion over the last 48 hours was that it looks so toppy, like it doesn't want to go, and then they came in and bought it, and that's look at the way silver is holding up. Now, obviously, this is the poor man's gold, but there's this previous high right along here, and it's like we need a drum roll to find out whether this cracks 20. Like this, it's pretty significant technically if silver gets going. Now, look, there is this previous high from 2016 up along here, but this would be like a 5-year high, if almost a 4-year high or whatever. If it broke, and I think that's interesting. Will it do it? I mean, you don't want me to Gucci? Like, you don't want to say anything?
No, I don't have a position. I don't know.
I just think it's a really important moment.
Yeah, I don't disagree. My gut was that it wasn't going to do it, but today's action in gold has got me.
But the problem is that we both agreed that there's room to pull back, which definitely means it's going to go higher.
That's right, for sure.
We're Gucci'ing it. All right. Anyway, that was our little talking chart segment, buddy.
Okay, so let's move on to This Week in Trading History. What do you have for me, Patrick?
All right, so this week in trading history, we're going to talk some ponies, gold dust, and railroads, and the launch of an American financial titan, Wells Fargo. So the Wells Fargo Bank has origins in the East Coast shipping industry in the mid-1800s. And throughout a series of mergers, splits, and risky bets throughout the 18th century's gold rush, Henry Wells and William Fargo would form the logistics company into one of the largest banks in America. And so before we get to the story, let's go to some of the beginnings. and what you should know about Henry Wells and Williams Fargo and some of the context of the times. So Henry Wells was born in 1805 in Vermont in a prominent family of influence with a silver spoon. And so Henry was the seventh generation of the Wells, with the original ancestor from the early 1600s being Thomas Wells, who was the only man in Connecticut's history to hold all four top offices of governor, deputy governor, treasurer, and secretary. So it was in 1836, Wells became a freight agent on the Erie Canal and soon started his own business. He then founded a shipping business which competed with the United States Postal Office by carrying mail at less than the government rate. And this company eventually became Wells & Co., which included the co-founder, Williams Fargo. As for Fargo, he was 13 years junior to Wells, and he was the oldest of 12 children and had a more modest upbringing. He bootstrapped his way up from mail carrier to grocer to freight agent and eventually started his own business. Funny enough, Kevin, actually, I noticed a few of the same fads back then that we have now. In the old days, it was shipping, and today it's like drop shipping. Back then, it was gold miners. Today, it's like crypto miners. Back then, Kevin had hair. Today, Kevin has no hair. Right?
I was gonna say I thought it was the beards. Those guys look like hipsters.
Oh, they do, don't they? Eh?
Yeah, they do look like hipsters.
So with all the shipping businesses competing, Wells Fargo realized they could make more money by creating a conglomerate. So they did, and together with some of other shipping companies, they founded American Express. Now, the discovery of gold in California in 1849 prompted a huge spike in the demand for cross-country shipping. Seeing this opportunity, Wells Fargo proposed the company expand west. But the co-founders were reluctant because California was already under the threat of a local monopoly, the Adams Express Company, which is now an equity fund, still trade under symbol ADX. Well, that didn't stop the ambitious all-American duo. Wells and Fargo ventured out and began to contract independent stagecoach companies to provide the miners with the fastest possible transportation and delivery of gold dust, important documents, and other valuable freight. So it was this week in market history, on July 13th, back in 1852, they founded Wells Fargo and Company. Yet this new operation wasn't just a logistics company. It also served as a bank, buying the gold dust, selling paper bank drafts, and providing loans to help fuel California's growing economy. So in the boom and bust economy of the 1850s, the company earned the reputation as trustworthy and reliable, and its logo, the classic stagecoach, became famous for a premium price. So, Wells Fargo and Company would even send an employee on horseback to deliver and pick up the package in that wagon. So they expanded and merged with several other Pony Express and other stagecoach lines in 1866 and became unrivaled leader in transportation in the West. When the Transcontinental Railroad was completed 3 years later, the company began using the railroad to transport its freight, and by 1910, its shipping network connected 6,000 locations from the urban centers of the East to the farming towns of the Midwest, to the ranching and mining centers of Texas and California, and the lumber mills of the Pacific Northwest. And so Kevin, I can totally picture and imagine you riding these rails, napping on your hobo stick pillow, tweed hat pulled down, and dreaming of shorting German boons. It's so anyway. So after splitting from the freight business in 1905. The banking branch of the company merged with the Nevada National Bank and established a new headquarters in San Francisco. During World War I, the U.S. government nationalized the company's shipping routes and combined them with the railroads into the American Railway Express, effectively putting an end to Wells Fargo & Co. as a transportation business. The following April, The banking headquarters was destroyed in a major earthquake, but the vaults remained intact and the bank's business continued to grow. And another 2 mergers, and they officially became Wells Fargo Bank. And it was in 1962. The official mergers of Wells Fargo occurred in 1962, and it became and has still remained as one of the largest banking institutions in the United States. And
that's a great story, Patrick. I like that one.
That's this week in trading history.
I think Warren Buffett was around for almost all of that. I know he's a big shareholder. He's been around so long. I feel like he was there for the start. Okay, let's move on to what WTF clip of the week. Taylor, hop on.
Hey. I'm just sitting here drinking beer, listening to Patrick, and it's a good time. It's a good Friday.
You buzzed yet?
Very.
Okay, so what do you got for us? What did you come up with?
So we all saw this week that Twitter was hacked, and it was all over the news. And as traders, we see history as it unfolds, and stay with me on this. You could see that as these moments come through, we can recognize them as being these future classic moments. Like I'm gonna remember that time when Bill Gates and Elon Musk's Twitter were hacked for like a crappy Bitcoin scam, right? But so we'd like to take those new classics and mix them with the old classics of like Ace Ventura. Like Ace Ventura is like GOAT, right? That's the greatest of all time. And I just mix them and it works and I'm happy and thank you. Enjoy.
So Pat, one second, Taylor, before we play it, did you tell us what GOAT was because you were worried that us old guys wouldn't get it?
I did.
I didn't actually know.
I did. Yeah. We can start a new segment where I just tell you. The thing is, guys, I'm 33. I'm not even new. There's kids rocking Segways and top buns, and I even think those references are old now. They're dated.
Yeah. Well, Segway's gone out of business. Okay, let's play the clip.
We're watching this story. Several high-profile Twitter accounts appear to have been hacked with comments posted about cryptocurrency. The hacked accounts include Jeff Bezos, Bill Gates, Elon Musk, Uber, and Apple.
That's quite a wrap you're wearing.
Who is this ghastly man?
Ace Ventura, pet detective. And you must be the Monopoly guy.
They put out a statement saying that this was a coordinated social engineering attack.
Another activist, McGuire.
Activist. Yes.
Activist, yes.
If they can hack Elon Musk and Bill Gates, some of the most technologically savvy people on the planet, we know that there's others who are very important, whose tweets and their words matter.
You know something? You're right.
Do not pass go. Do not collect $200.
Alrighty then.
That was awesome. Ace Ventura, I remember watching that as a kid and loving it. That was a shit back then. I haven't watched one of those movies in way forever. But that was when Jim Carrey was at his peak. I mean, I think his peak was Dumb and Dumber, wouldn't you think?
Oh yeah. Oh, for sure. For sure. I've been we watched Naked Gun recently. Oh my god, these slapsticky 90s, they're phenomenal. They don't make them anymore.
Oh. Well, we got to talk about that at the end of the show then. But then nonetheless, it was a great mashup. I loved it.
Thanks, guys, and I'll see you next week.
All right. So let's move on to the top 3 things to watch next week. Kevin, let's just review last week. And I was talking bond yields, and I was like, it was boring. And then earlier today, I was like, oh, it's going to crack spot 60. Maybe we're going to have something to talk about. Nope.
I'm completely convinced that bonds are going to be the most boring place to be for a long time.
Oh, we should get into the premium harvesting business.
Well, vols come way in, and not only that, when I start telling you it's going nowhere, that means the bear market's finally going to come because I won't be there. I could just see that happening. But honestly, if you have all of the central banks of the world pegging the front end so low, and even though
and they're buying everywhere on the curve.
Yeah, it just ends up being boring. I'm increasingly convinced that FX is going to be where it's at. Anyways, let's go on. Number two.
There we go. So obviously we had Bank of Canada and the ECB.
So Bank of Canada was interesting because it was the first one with the new governor. And what I thought was great was, or not great, at least interesting, was the fact that he came out and said, we are not going to raise rates for a couple of years. We want people to buy and to spend. And I've never heard that so blatantly just said out loud. It's just shocked me, Patrick. I looked up and said, did he just say that? Like, is that really what?
Do you think that's what added that tailwind to the Canadian equity?
Oh, for sure. I think it definitely helped on that day. Now I get it. The Canadian dollar rallied at the same time. A couple of different things happened. One of them, though, as well, is that he took negative rates off the table. And I thank God, because negative rates have got to be the most bonehead, stupid decision that has ever occurred. And we will look back at negative rates and hopefully history will not be kind and realize they are an abomination. And I am so thankful.
Because you could create financial repression without having to have negative interest rates, and it just doesn't work. Like it's trying to apply a solution to the problem that doesn't work. So they keep trying to make more private sector demand, and obviously the private sector, there is no demand. So if you take it below at negative, you're not going to get anyone to go and borrow anymore. Nobody goes and says, "Oh, I was going to borrow at 0, but now that it's minus 25, I'm going to borrow." Yeah. The reality is that the reason they're not borrowing at 0 is because they're very worried about the actual strength of the economy. So lowering rates to negative doesn't work. Dumbest thing in the world. I see these fellows, and it's who is it? Carmen Reinhart that gets on there and starts talking about getting rid of cash so that he can put in the rates negative. Stupidest bloody thing I've ever seen. I can't tell you how frustrated and how dumb that makes me. Oh, Patrick, don't even get me started. I'm at a loss for words. All right. And finally, last week we were talking about the FANGs going parabolic, and well, you nailed it. We don't even have to say anything else. The market literally came in Monday, blew off, and all of those FANG stocks are backfilling. And so we're going to include something like this on the top 3. So let's leave it at this. So let's move on to what we're watching next week. And one of the things that in typical fashion, there's always a gamma pin that typically happens going into an option expiration. And the S&P more or less did stay flat in the last couple of days. And we have a market that it seems like it's ready for a little bit of volatility. And you know what? Obviously, I'm always too bearish, but I'm just asking that important question. Do we finally get the markets moving, or are the summer doldrums going to truly be there? The one thing going here is that we're going on a quasi-vacation here in the next couple of weeks. And, you would think that it would be only appropriate that shit starts to hit the fan when we're not online. Is that a fair way of
I would agree. Having said that, Patrick, I leaned into the open today. I was right for about, an hour, maybe 2 hours. And the market sold off.
And then you ate it.
And then all of a sudden it just went bid again. And I'm surprised. I thought there was lots of reasons for it to go down today, and it didn't.
Yeah, but it is Friday of OPEX. So I would be a lot different if you leaned into it on Monday.
No, I disagree. I think that usually it's the open that all the index stuff comes off at the open. Yeah. I think it's more influenced by the index stuff than the individual.
Right.
And so I think that I was surprised at the strength at the end of the day. I don't know.
All right.
It wouldn't. So given that it didn't sell off, and given the fact that we just put it in the top 3, I almost think it's going to keep going higher, and it's that we're going to be wrong.
All right. So number 2, let's talk about tech earnings, because obviously Netflix missed.
Yeah,
disappointed because let's be realistic. They had a huge surge from the COVID. And it's not realistic that they could maintain that kind of rate of change. And so they had to kind of bring back down to earth the expectations for the next quarter, and the stock got punished. And so here we have another wave of the Titans, Microsoft, Amazon, the Teslas, and we're going to get it all next week. What's your intuition on this?
So usually I feel that selling volatility going into earnings is a mug's game, and you're actually going to lose on the whole because people overpay for earnings volatility. Part of me thinks that this is there is so much economic uncertainty. I think there's going to be some blowups in here. Wouldn't surprise me at all if Netflix doesn't end up being the worst performing stock coming out of this, and that there's worse. And I think that the tech stocks have a lot of good news priced into them. And
they have lots of room to disappoint.
Yeah. So
all right, I hear you. And so,
what do you think? 1 second, I should ask you.
No, I think that they've all gone parabolic. You know what? Whether we get another wave of a bear market leg lower or we get asset rotation, the one thing I feel is that these tech names have gone too far. And even if the market doesn't sell off, we should get rotation into different sectors. And I think that the sector that has so monstrously outperformed, there's going to be a convergence of that divergence. I think that
convergence of that divergence. I like it.
There you go. And so
wise words from the maestro himself. Okay, number one, what we're watching this weekend, EU Economic Summit. I saw when I was watching Bloomberg today that they said that things have gotten serious. They're not giving them food in a hope that they come up with a solution. Honestly, I saw this.
Them food.
I honestly saw this. And I was like, holy shit, what's the world coming to when they're not giving them food? I have been burned so often assuming that the Europeans would come up with some sort of solution. I'm a seller. I'm a skeptic, which means that they're probably going to come up with a solution.
So, and you think that this could potentially be a catalyst that Gucci's your bet?
Don't want to mention my bet, but I will say that they
Damn
often
it. I just want you to Gucci it. Like, come on.
I don't want to mention that. That's something that compliance won't let me mention. So anyways, I'm really worried because I think that there's a lot riding on this EU Economic Summit, and it's I think overseas a lot of people are talking about it. I don't think a lot of the people in North America are paying attention to it. But if we got a situation where it all fell apart and ended up disappointing, I could see a situation where all of a sudden boons are bid, European stocks are for sale, and that leaks into the U.S. market.
Wow.
So make sure you keep your eyes on it. Let's hope I'm wrong, and let's hope that they come up with something. But I'm a seller.
There you go. So parting words of wisdom. I picked this one out. It's from Warren Buffett. And it's the stock market is a device to transfer money from the impatient to the patient. And, it resonated with me because obviously at Big Picture Trading, we've been messing around with some trading psychology stuff, me and you. And, it really comes down to the psychology that when people look at a stock and it's not doing what they want, they immediately want to sell it to go into something that is working. And it causes many people to performance chase, which is usually not an alpha creating strategy. And sometimes being patient and seeing something through does. And I just thought this was words of wisdom.
Well, that's great. I wonder if he did it in between naps, as Dave Portnoy always accuses him.
All right. Let's put this to an end.
Okay. Well, that's it for our main show this week. We appreciate you tuning in. We couldn't do this show without all of you. I want to thank our guests, Nancy Davis from Quadratic Capital Management, the founder of the IVOL, and also Ben Kwasnick from SPAC Research. And if you like what we do over here at Market Huddle, please share it with your friends. You never know, the bigger our following, the better chance we have at getting people like Warren Buffett to come and maybe speak to us on Market Huddle in between naps. Before we go to the after show, here's where you can find us. It's at the Market Huddle on Twitter. And Patrick, how about you? Where can they find you?
You can find me at Patrick Ceresna on Twitter, as well as at bigpicturetrading.com. And where can they find you, Kev?
So I'm at Kevin Muir, KevinMuir, and you can go and check out my newsletter at themacrotourist.substack.com. And listen, we can never have too many friends. Bull market, bear market, we're just happy to spend time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right, Lena Taylor, hop on.
Hello.
Hello.
Oh my God!
I'm just gonna go ahead and say I didn't watch Producers.
I didn't do it.
Thank you. You didn't. You know, shame on the both of you.
I know.
I had too much work to do, so I could.
I know.
Patrick,
we're working her to the bone.
You didn't ask me if I watched The Producers.
Did you?
No, I didn't.
You piece of shit. You're honestly a piece of shit. I can't believe I just got goaded into that. All right.
We saw it all. We all saw it coming.
Oh my God! Why did I fall for that shit? Okay.
Because we knew you'd fall for it.
But we were talking about during the WTF some of these other movies. Like, you know, that was back in the day when I used to watch movies. Like, I used to not miss any of those. Like, if you talk to me about movies from like the 90s and early 2000s, I've probably seen most of them. It's all these modern shit that I haven't been on the ball with. But there was some pretty classic stuff. But what I loved, Taylor, was you were talking about Naked Gun. Like, did any or like Airplane and all of it? There's some some absolutely classic shit that you can't touch that shit. I even actually, you know what's another one? Hot Shots. Hot Shots and Hot Shots Part 2.
Yeah.
Oh my God, those were
so good.
That's my type of comedies.
Like slapstick. Like they did slapstick so well. It was unbelievable. Like, you know, it's unfortunate that like Charlie Sheen and like O.J. Simpson featured in these, but they did some amazing like physical comedy in there that isn't really done that much anymore. Like who does it now? Like then it transitioned into like Ben Stiller and like and Jim Carrey, but then it's like who's the new guys doing like slapstick? Like Jack Black, you know, who's doing what's a good slapstick?
No,
I'm very
maybe
passionate.
Will Ferrell. No,
it's you know, it'll make a resurgence. There's going to be another generation that's going to bring it back.
I don't know. I think you guys are wrong. I think there's plenty of good movies like that. Like if you go
what?
Tropic Thunder was
Tropic Thunder's unreal. Yeah.
But that's like 10
that was
what
good.
was that 10 15 years ago, dude? When was that? That's not a recent movie.
Yeah. What about the Korean one with Seth Rogen? He does kind of the same dumb things. Seth Rogen and Will
but yeah,
James Franco. The interview or whatever it's called.
Have you guys ever seen the part where they do the motorcycle scene together? They strip down like to their bare shirts and they go like, who was it? It was like Kanye or somebody did it, and then they decided to emulate it. Kanye and Kim Kardashian or whatever her name is. You guys don't know what I'm talking about?
I know what you're talking about.
Everyone's leaving me
hanging.
hanging.
No, I know what you're talking about. I just didn't know who they were modeling after.
Motorcycle. Who was it that they were doing it after somebody? I don't even know who they were doing it after.
Oh, yeah, Seth Rogen and James Franco, Bound 3.
Yeah, Kanye West and Kim Kardashian. They did a music video where it was basically just them on a bike, and so the two of them did this thing, and that's just hilarious.
So good.
Seth Rogen is so funny.
Yeah, he is.
Do you know what though? I saw this show, but with him on it, where they go out with it's some famous chef. I don't know anything. I just like eating food, don't like making it. So I don't know any chefs, but there's some famous chef that has this TV show where he gets a celebrity and they go to restaurants in their hometown or somewhere interesting, and then they walk around. And
Is this the Asian chef?
Yeah. What's his name? Do you know it?
I think it's David Chang or Dave Chang.
Oh, Dave Chang, yeah, from Momofuku.
Oh, is that who? Yeah, that's it.
Yeah,
okay.
Momofuku.
So go watch the Seth Rogen one. They are high
They're high the
entire time. It's like every second, like, oh, we got to take a break and get, like, smoke a doobie. Like, they're just like, he's just like, this guy is so high. And one of the funniest things I've ever seen is Seth Rogen got on, like, it was Letterman or somebody like that, and he explained how he got high before a flight when he was flying from LA to Vancouver, and he decided it would be a good idea to get the flaming hot burger from Burger King. And he's like, how hot could it be? Like, what the hell? Like this can't be that bad, right? So he gets himself just completely baked out of his mind, eats this burger, and then hops on a plane. And it's just the funniest story ever to listen to him talk about.
So good.
Yeah, he's a true Canadian. I gotta like him.
Yes.
Yeah.
He's definitely a true Canadian for sure.
Yeah.
Yeah.
But we got to rate the beers.
Oh yeah. Sorry, Lena, you're like keeping us on track.
Or the
I
beer.
like it.
Yeah.
I'm gonna go
we gotta
first.
rate it.
9-1.
What?
I loved it.
Whoa, the beer almost came out of my nose.
Yeah.
What?
I liked it. I don't know why.
I can't believe this.
It's something about it.
It is a good beer, but now I feel like I have to do the opposite of you, and I'm like the impulse to rate this high is now diminished.
Well, I should have to write them down. Be truthful, Patrick. Be honest. Like don't. Okay, so Lena, you go first.
I quite liked it actually. I was scared to drink it before I opened it because I was like, oh, I think it's going to be super hoppy or super sour. I wasn't sure, but it's definitely drinkable. I would give it, like a really high score. But I'm not going to give it like a 9.1 like you did. I was going to give it an 8.9, so just as close.
There you go. Okay, Taylor, we'll keep Patrick for last. Taylor, you go.
I would say like an 8.6, and I'll tell you why. It's because I love hoppy beers. This was very cold. I did it properly. There's no bias anywhere. It was missing something at the very end. I could have used a little wick at the end, like a little lip of like a bite.
A little punch at the end?
Yeah, a little something that grabs
you.
It was a little flat at the end. But it was
that's
very
exactly good. What you described it perfectly. It's a little flat at the end. I totally know what you mean.
Right?
I know exactly.
So what are you doing, Patrick?
Well, first of all, I just wanted to point out, like, I was shocked when I tasted this because honestly, I'm going to give them like a 5 out of 10 for just the picture, because the picture makes it, with the tank on the front, it makes it look like that I'm about to get punched in the face, and it actually is and it actually tastes like a nice, good beer, and the picture scares you away from buying it. So I'm giving it a 5 out of 10 on marketing. With that said, I did enjoy it. And I'm going to give it the lowest score of all you, 8.5, but it is a good beer. But you know what? I always kind of in the back of my mind ask the question, would I buy a 6-pack to put in my fridge? And that's why I'm giving it the lowest score out of you guys. Like, I would drink this. It's a delicious beer, but it's not sessionable.
There we go again.
Sessionable. Sessionable.
That word makes a comeback.
No, but listen, and those of you that can get your hands on it, it's worth a try. I actually, look, we all gave it 8+, right? Like, there's no reason why anyone should not grab this beer, but I just wanted to kind of give it my little 2 cents. Anyway, I'm done. You guys talk now.
Okay, so what's everyone's plans for the weekend or the week ahead?
Did we talk about turbos?
Oh,
we mentioned turbos?
No. Okay, there we go.
We got to do a follow-up
turbos.
of turbos.
Okay,
like,
that's
we had a market huddle brainstorming session, and let me tell you, we got a lot of fun.
A COVID-free huddle meetup session.
Yes, very distance safe.
Yeah, and we were and you pulled out the turbos.
The turbos,
I enjoyed them.
So why don't you tell everyone, Taylor, what a turbo is for those who don't know, because I didn't know what it was.
Okay, so a turbo is like half Budweiser, like half Budweiser and half Smirnoff Ice poured over ice, like ice all the way to the top. So now, before we get into what it tasted like, remember Patrick and Kevin were both like, I'm not doing it, right?
Budweiser, Smirnoff Ice.
It's
true. I was skeptical. I will not deny that. I said I would try anything once. And I went back for I tried a little bit, and then I filled my glass with it because I liked it. Yep, it is a girl's drink, but that's fine.
Hey now.
It was actually very tasty. I was quite shocked. It was way better tasting than I thought. I'm a big believer you shouldn't put any fruit in beer. So the moment that it was like a cooler, which probably had some fruit taste in it, I was very skeptical. But it was tasty.
Fruit?
What do you think?
What do you mean?
Patrick?
It's Smirnoff Ice. What do you mean fucking fruit?
It's got some it's a sweetness to it, so it's kind of
Fruity
fruity.
Yeah,
It's no, it wasn't fruity. It was sweet, but it wasn't fruity.
Oh, you want to get technical?
Smirnoff Ice. I'm looking it up right now. Smirnoff Ice flavor, and I can't find it, but it is somewhat. It is somewhat like citrus. There's natural lemon lime flavor, but anyway, you have them. It's like this. What's the word? Like like molecular cooking, like lobster and white chocolate are two things, but when you mix them together, it creates something brand new. This is like the equivalent of that in like a summer drink. Like you pour these if you have these at a pool party, best day of your life.
And particularly, but you say pool party, but the place that I do now remember having them years back, and this is why it kind of didn't jog my memory until you started firing them up, was I had them on a golf course. And that's actually an interesting kind of, like if you're golfing for 4 hours and they're coming back by with a golf cart, it's an interesting drink to kind of, it's somewhat refreshing. It's cold. It's like something that doesn't get you hammered.
Yeah, because you can't taste the alcohol in it, and then by the time you're done the 18 hole, you're hammered.
All I know is that my friends would. I tried to pull it out, and they all shamed me. So it's like, you know what? As a Gen Xer, it's something that is not socially acceptable, and I will never be able to pull it off.
Can I just go back to this?
I'll be a closet fan. I will. I will like secretly make one and no one sees, but I can't make that my drink. Sorry.
Can I go back to this lobster and white chocolate or whatever you talked about?
Yeah.
I'm still thinking about this. What did you say and what is it?
Okay. So there's this thing called it's like molecular cooking. Like I don't know if David Chang, I'm sure knows of it. I don't know, but it's pretty much you take
gastronomy or whatever they call it.
Yeah,
I think that's
and so they take they take things that molecularly go well together. That's the theory behind it. So anyway, lobster and white chocolate is one. I mean, I can Google some other ones for you, but it's pretty much that two separate things combined together to make something new. Oh, okay, if you didn't hear that, do you know umami? You know the flavor profile umami?
No.
Okay.
I'm Gen Xer. I don't know.
All right. Well, I used to work in yeah. Anyway, it's like ketchup. Ketchup is umami.
What?
Or soy sauce.
No, guys.
I don't know.
Patrick, it's like a flavor profile that's beyond your the taste buds, right? It's like the feeling that you get in your mouth. It's not so much the flavor. It's like
there's
I'm confused and I'm drunk and I'm
I think we'll just leave it at that. Okay, let's give him one last shot to try to do this, and then I'm going.
Okay, umami is the savory taste. It's one of the 5 basic tastes, together with sweetness, sourness, bitterness, and saltiness. And umami is the 5th one.
There's a 5th one?
There's a 5th one.
That's like the 4th dimension.
Yeah, you just freaking blew my mind. I didn't know that.
I didn't know that either.
So, don't be knocking white chocolate and lobster till you try it. Or rockets, bud.
Are rockets are rockets or whatever those things are
Turbos,
they unamis? Are they unamis?
No, they're not. They're just new, Kevin.
Oh, I don't really get it. I'm still confused. I'll go Google it. I'll figure it out.
Two separate things.
I'm gonna go get like a Mars bar and some scallops and see if that works. Okay, everyone have a great weekend. Thanks for tuning in, and we'll catch everyone next week.
All right, thanks, everyone.